Let's talk about how to identify key liquidity pools and why liquidity is so important. And the reason why liquidity is so important is because it's essentially the lifeblood of the market. Now, what that means is that price will always move to take key highs and key lows. That's all the market does. Any market, forex, indices, crypto, commodities, stocks, they all move for highs and lows because there's something called liquidity there. Now, liquidity is simply just orders, right? Because I'm sure you all remember support and resistance. When we have bearish movements like we do here, a lot of people are going to short, right? A lot of people are going to be here. Remember, we're on the 4 hour chart, so a lot of people are going to be short here, 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 all the way down here. And where they logically put their stop is right at the top of here, this level here. They'll put their stop loss here. Now, of course, some people will have their stops here and here, right? But the most stop orders will be here. Now, stop loss orders is essentially what liquidity is. That's all it is. It's just stop loss orders. So when you think of liquidity, you got to think, where would people actually put their stop losses? Right? That's all you need to do. So you can keep liquidity nice and simple. But liquidity at its most basic form is highs and lows. And what you'll see is that the market will only move to take out highs or lows. It does not move because of buying pressure. It does not move because of supply and demand. It does not move because of any of that. It moves only for highs and lows. And right now, on GBP USD, we're in a bullish trend, right? We're bullish. And what you want to do is you want to wait for it to be so obvious, so clear what high it's going to go for, or low. And in this instance, because we're bullish, we have this clear high here that we've talked about. Let me make it a bit more clear. This clear high right here that price wants to go to. All you want to do is just target this high. Target this high. And what you want to do is you want to wait for it to be so obvious what high we're going to go for, or low, depending on your bias. But because we're bullish, right, because we're so close to this high, it's obvious that we're going to take this high out, right? Hope that makes sense. Price goes for highs and lows, that's it. So we've now identified this high that price wants to go to. So we only want to be trading in that direction, right? That's how you determine bias, by just targeting liquidity. That's all the bias is. And another word for bias is trend, right? Trend. Where are we trending? We're trending upwards. We're bullish. So yeah, all you've got to do is target highs and lows. And this is what we call a liquidity pool because there's a lot of stop loss orders there. So nice and simple. And what you'll see, as you can see here, we've taken out this high. But if you go into FX replay, let's say you're on the charts at this point, right? You're the charts at this point. You see this clear key liquidity pool and price actions like this. What are you going to think? You're going to think clearly we're going to go and target these highs, right? You're going to think that we're either going to go straight for the highs like that. That's scenario number one. Or scenario number two, which is my favorite, is we have like a little retracement down and then we go up, right? This at its most essential form is buy the dip, right? You've heard, buy low, sell high. That's essentially what this is. And that's essentially what my entry pattern is. And this is essentially my entry pattern, which is why I think it's so easy just to take this optimal trade entry like that. Just a Fibonacci retracement, targeting these highs. It's all you need to be profitable. All you need to be profitable is to target highs and lows. And whatever entry pattern you use, make sure you're targeting highs and lows. And then you just let the market do its thing, right? Just like that, boom. Straight away, we've taken out liquidity and we're done. Back to where we are now. Price only goes for liquidity. And if you noticed, we also took out this high here. This high here. Right? And this is key because this high is not only another high on the 4 hour chart, it's also a high on, let me get it up, the daily chart, right? See this high here, the exact same high. Now this is absolutely crucial, because here's the key thing about liquidity that you don't hear. The higher the time frame, the more important the liquidity is, the more significant it is. Price will only move for higher time frame liquidity, right? That's where the market direction is. We're moving up, we're bullish because we're moving for higher time frame liquidity. Right? We're not moving up, we're not bullish because there's a 5 minute high that price wants to go for. Although you will see liquidity grabs, which is a lot more complex and it's on the lower time frame. But the higher time frame is the 4 hour, the daily, the weekly, and the monthly, right? And you don't want to look at the monthly unless you're trading, the weekly chart. But if you're a swing trader, you've got the 4 hour and the daily chart. But all you need is the 4 hour chart. And the reason why is because the 4 hour chart is simply the lowest higher time frame liquidity, right? You can see the daily chart high here. Very easy, but you can't see that daily chart high, obviously, on the 15-minute chart, right? It's not obvious at all. So you want to use the 4-hour chart, which is why I like just trading the 4-hour chart. The moves are fairly quick, last a few days to probably about a week, at most 2 weeks. You know, it's nice and slow. You can set up your limit orders in the morning. It's the best chart to trade. But the key thing is you want to target higher time frame highs and lows. On the lower time frame, it does work, and we'll show you now. Let's go on the 5-minute chart. It does work, but you see how we're bullish, right? See how we have all these highs here, right? You'd be completely right, completely correct if you said, "Oh, well, we're bullish, right? Because look at all these highs here." Completely right, absolutely correct with your bias, but you would still lose because this is what happens on the lower time frame. What this is just a liquidity grab where it's going to grab all these lows and then go straight up. Now this might look like a huge move. When I go trade the 5-minute, you think this is a huge move. Clearly we're bearish. Market structure shift, the bias has changed. Whereas if you go on the 4-hour chart, it's barely even notice. You can barely even notice it. Do you know what I mean? Like it's not even gone anywhere near where you'd expect it to go, like that. So this is why you always want to be on the higher time frames. Now you might want to be a day trader scalper, of course, but you still need to target higher time frame liquidity. And all you need to do for liquidity is target highs and lows. And the best way to learn liquidity is just examples, right? Just examples. So the more and more examples you can get, the better. Okay, right now we're on gold, and I want you to pause the video and decide where is the higher time frame liquidity? Where is the key liquidity that price is going for, right? Just think for a few seconds. Where is the higher time frame liquidity that price is going for? If you're on the charts here, right, you're on the charts this time, where would price be going to? Where's the key high or key low that price is going to? Right? Now, I'm going to assume that you've done it now. It's very obvious that price is going to go to this high here. It's extremely unlikely that price will, let's say, when it's right up here, go straight down like that. It's very unlikely. What you could see, and you do get this occasionally, is that price will come up to the high, leave the high in place, and then go down. That's what you call engineering liquidity. And all that means is that it will leave two highs in place to create more and more liquidity. More and more people will short this move down here. Right, they'll short this move down here, and they'll put the stop at here. So what will actually happen is you'll get a retracement like this, and then you'll smash through. And you've got double highs there. Lots of people are shorting it. They've got their stops there because they think it's really good resistance. The market doesn't want to go any higher, and that is what the market will do. And this is why you hear draw on liquidity. Draw on liquidity means that price, regardless of whether it takes out highs or lows, it will move towards highs and lows. This is why I say the whole market moves on highs and lows. Even those people who trade support and resistance agree that the price will move for highs and lows. That's it on the higher time frame. So I hope that's clear. Now, what would you expect would happen? Clearly, that we're bullish. There's two things that can happen. You either get a retracement like that, and that can be your entry, or the market will just go without you. And look, you are going to miss moves, right? You are going to miss moves. It's just the way trading is, and this is why I'm a big believer in having a large watch list. So if you're a swing trader, you can trade all assets, and if you're a day trader, I'd have at least 3 pairs that I trade: Euro dollar, Aussie dollar, and GBP USD. Those could be 3 good pairs to trade. Or if you're in Asia, you could do Aussie dollar, maybe dollar yen and GBP JPY. There you go. You want to have as many options as possible so you can be selective. So let's run this price action and let's see what happens with gold. Right here, do you remember how I was saying that price can sometimes leave like relative equal highs and then retrace a bit? Lots of people are shorting here again because they see this and they see that this high was left in place. They think that this is a great selling opportunity. They think this is really good resistance. Yeah? And you might not believe that people trade support and resistance. I'm telling you, there are large funds who have billions who trade support and resistance. Right? They trade support and resistance. They're right maybe like 20% of the time. But when they are right, let's say, when they are right about the direction, they aim for a huge, let's say like almost like 10 to 1 because they're trying to capture, weekly moves. The whole weekly and monthly trend. Right? They're happy to hold on for months. They're not looking for little day trade scalps, but their entry would be something like this, right? Something like that. Probably targeting these lows or something, or like a key number. But look, they'll lose a lot. They'll lose maybe 4 times out of 5. But when they are right, they'll make more money than they risked. And when they're risking billions and they might make, 10% a year, that's a lot of money for them. It's a lot of money for them. So that is why the market moves for these highs and lows. And here, right here, a lot of people are short. A lot of funds are short and they think they've captured the move. Now there's two things you can do. There's two ways you can play this. You could just literally buy the dip, right, like this. So you could have an optimal trade entry from this low to this high like that. And then you could aim for a 3 to 1. You could do that. You could do that. Now, there's one issue with this. There's one issue with this. This could be a great opportunity, but the only thing I don't like is this fair value gap here. Because what happens, and not all the time, you won't always see this, but a lot of the time, if you've got a low next to a fair value gap, that low is almost always taken. Not all the time, but I'd say probably about 80% of the time it's taken. Right? So write that down. You don't hear that a lot. That is from trial and error. That is from me suffering. I'm telling you, price will often, not always, but often do that. Right? So me personally, I would have this as my entry. Like that. Like that. That'd be my entry. Retracement up. And I don't think we get it this time, so let's play the price action. Like that. So if you were there, you would have been right in this instance. And then boom. Straight for liquidity. Straight for liquidity. Straight for it. And another thing you'll see is when price goes for liquidity, it'll have these huge candles. These huge candles because they don't want people to pull their orders. They don't want people to see price action coming up and think, oh, let me just take my order off now, cut my losses. They want to just instantly shoot through it. And you'll often find this during news events like CPI, FOMC, and non-farm payroll. That price action will just shoot through these highs and lows. Shoot through them. So yeah, there's an example in gold, and it works on all markets, and I'll show you an example on indices. Okay, this one's a more difficult example. Where is the most obvious liquidity on this chart? Where's the key high or low that price is going towards? Where is the most liquidity? Key highs and lows that price is going towards, right? I'll give you a hint. Think about the current trend that we're in. Where's the most obvious highs or lows? Where are we most likely to go? Are we most likely to do this and then maybe retrace? Or are we more likely to do this and take out these lows? Which one do you think is more likely? Right? Take your time. Okay, the most obvious liquidity here that price is going to go for is these equal lows, right? These equal lows. Now why? We've clearly had a strong move downwards, strong displacement downwards, and to make it even more obvious, we've had two equal lows, relative equal lows. Now people think this is great support, great support. So lots of people have longed this move here. They've longed this move here, this bullish move upwards. They've gone long, thinking this is great support, and they've put their stops here. Right? This is what you want to see. This is exactly what you want to see when you're going short. And you might be thinking, oh, this looks scary, seeing all these green candles going up. And yeah, it is scary. It is a bit, you get used to it over time, of course, but at first it is scary. But the best trades, and the only trades that are really profitable, is you have to buy as price is going against you. You can't be chasing price. You have to wait for price to come to your key level. And in this instance, remember how I said price was two things, right? It either goes straight down, or, and we're starting to see it here, it has a retracement like that. And there's also the third scenario in which it just takes you out and then goes, right, of course you're going to have losers, right? But here, the key liquidity is down here. And if you're on the charts at this time, or if I was on the charts at this time, there's two things I'm looking at. First is this key low, and second is this gap here, right? And although this isn't liquidity in the sense that it's highs and lows, this is what people would call a liquidity void. Liquidity void. That means that price, there's not really been any trading here, right? There's literally a gap, so there's no price action done here. The market, whether you think it's an algorithm or supply and demand, it always likes to fill these gaps in. It doesn't like to leave these gaps open, not for long. So it is very common that you'll see these gaps get filled like that, and then either go down or go up, depending on the bias, right? So I see that, and I like that gap. I like that gap. I think that's a great draw on liquidity. That means that price is likely to go there and then reverse. So if I'm on the charts, and remember on the 4-hour chart, we've got the key higher time frame low. Set my optimal trade entry, like that. And I think we just miss out on it, but we will get filled. I'll show you in a minute. Stop at the high, aim for a 3-to-1, just like that. And then we play price action. Now you would be here if you were trading like me. I'd have my limit order here, stop there, take profit there. Now I wouldn't know if I get filled or not, and it's up to the market to decide. So let's play it out. Boom. Look at that. Look at that. Straight up. What did I say? Straight up here. Let me get rid of the Fibonacci. See how it smashes through our target with the strong candles. Remember how I said strong candles against you? So what we have, see this gap that I marked out. Price will come up, fill these gaps, and then go straight down. Come up, fill these gaps, and go straight down. That is how you use liquidity. The market only moves for highs and lows. Highs and lows. Now you might be saying, oh, well, we were quite close to this high. Yes, we were quite close to this high. But you got to think how many people here are short versus how many people here are long, right? Because people keep thinking that we're in a bull market, that we're going to go up forever and ever and ever. You got to think where's the most obvious highs or lows. And here, especially when you see relative equal lows, when you see double lows, those almost always get smashed, right? So if you're ever in doubt, if you see one high and two lows, you want to go for the two lows. Two lows are a lot more likely to get hit, a lot more likely to get taken. And the final example I'll show you will be on stocks, because I want to show you that this works on all assets, all markets. This really does work. Okay, now we're on Tesla, and here's a trade I did take. I want you to decide where's the most obvious high or low that we're going to go for. Are we going to go for highs or are we going to go for lows? Right? Where do you think, based on this price action? If you're on the charts at this moment in time, where do you think the most obvious high or low is? High or low? Right? I'm going to tell you, the most obvious place of liquidity is this high here. Right? See how we have almost relative equal highs? Relative equal highs. And you always want to be targeting highs and lows. And you want to be targeting the most obvious high. Now, yeah, of course, could price take out these lows? Yeah, but is this low obvious? Not really. These relative equal highs are very obvious. A lot of people have been short on Tesla. There's lots of liquidity here. We have almost relative equal highs right there. What you want to see is a retracement and ride it up. And here's a trade that I took. What I did was I put my Fibonacci here to the high. As always, for those who know. Now, I don't trade stocks. I just tape Reddit just to see like what would happen. Because yeah, I think for stocks you're gonna have to use options, and that's a lot more complicated. It's just easier if you're a beginner to just focus on forex and indices. But it does work on stocks, and it's something that I might do later on. But yeah, yeah, it works on all markets. So let's play it out, right? My entry is here, 3-to-1. Now there's two things that can happen, and this happens a lot. Is that the market could retrace like that and then go without you. Could go without you, and you will miss moves, regardless of whatever entry pattern you have. If you have a fair value gap, order block, anything, you will miss moves. Even an indicator, you will miss moves, and you will be right with the bias. The key thing is not to chase moves, right? If you're here and you see that price is going up, don't start buying it, saying, oh, Atif said that it's going to go for these highs, so I'm going to buy it because it's going to go there. Do not do that, because price will retrace against you and stop you out and then move. Always have your entry and always trust your model. Always trust your model. But anyway, stop rambling. let's play this price action. Right, so let's play the price action. Let's make this a bit bigger. Right. You want to see a retracement. There it is. At this point, you might be nervous. You might be nervous, but just trust the process. Trust the process. Let it hit your take profit or your stop loss. And then here we go. Here we go. There we go. Bit more, and then boom. Look at that. And what do I always say, right? When oops. So we're at live price action now. When we take out, let's just remove all this, and let's just mark these highs back out. When we take out key liquidity, like this high, when price does it, it's always huge moves, huge candles. You see how we had a gap? A gap means that price wants to get somewhere quickly, wants to move fast. So right here, we chopped around for a bit. A lot more people were shorting, thinking, oh, you know what, triple highs is really good resistance. And then boom, we smashed straight through it. Strong displacement, strong big candles. That's what you want to see. And yeah, that's what liquidity is. If you look at the market, it's purely based on highs and lows. But the market's going for highs and lows. You'll see the same thing over and over again. Look at this, right? Let's go look for this chart. This high here. Bam, straight through the high. This price here. Bam, straight through the high. These prices here. Straight through the high. This low here. Straight through the low. And so on and so on. The only way it won't work is in consolidations, but you never want to be trading consolidations. You never, ever, ever want to trade consolidations because it will take out both highs and lows at the same time. And yeah, no strategy works in consolidations. You do not want to trade consolidations, but just wait for it to be so overwhelming and obvious, right? So overwhelming and obvious, so clear what low it wants to go to or what high it wants to go to. You don't want to be guessing. You want to come to the chart and see right away. It's so obvious that it wants to go there. So obvious. That's what you want to see. It should be so obvious. And if it's not obvious, then look at another asset. Let's look at let's do Apple. Right, stock that I literally not even looked at this stock. Let's see what this stock does. Let's go freestyle. These highs here, right? Right away, my eyes jump to these highs here. They're not relative equal highs, but they are pretty decent. Got these highs here, and then price goes straight through them. Look also how we respect it a bit. Where the bodies close it, and then we shoot right through. Because some people think that's the support and resistance are like general areas, so they'll short around this area. And some funds, they won't always have their stop loss, their entry right here, right? Their stop loss. They might have it like, let's say that they give it a bit of breathing room. So that's why price often smashes through them. Doesn't just take it out a bit, it smashes right through them. So there you go. So all you see, if you look at price action, all you see, highs and lows, this low here taken, back up, taking out these highs, these highs, these highs here. And you probably would have thought we would take these highs out, but we didn't. And in that instance, you would lose. You'd have a losing trade, a loser. Normal in trading, and you've got to be ready for them. But yeah, I hope that makes sense. You want to target key highs and key lows. You want to stick to the higher time frames, and you want to wait for it to be so obvious and clear. If it's not obvious, if it's not clear, do not trade. Find another pair, another asset, anything else to trade. Do not force these setups. Wait for it to be so clear, so obvious, so overwhelming that there's no doubt. Right? Keep trading simple. All you need is highs and lows and one entry pattern. One entry pattern that targets highs and lows. That's all you need. And risk management and emotional control, and you'll be profitable. Simple, simple, simple. I hope this helped, and if it does, like, subscribe, and leave a comment. Peace.